Good morning, everyone. You are watching a live daily market outlook for Tuesday, 3rd of April 2012, prepared by Windsor Brokers. It seems that the latest price action actually shows that the risk appetite is back in play as euro and sterling are again pushing higher, and the dollar lost ground overnight late yesterday and overnight against Japanese yen and the Swiss franc. The dollar index also dipped to as low as 78.68 seen during the Asian session, holding the lower levels as some solid data from US yesterday's manufacturing PMI that was released in the late hours of yesterday showed actually put some pressure on the dollar and turned more risk appetite to the investors. The manufacturing that strengthened in the United States, in China in March, while the Eurozone contracted for the 8th straight month, underlining the uneven pace of global economic growth. Yesterday's ISM showed its US factory activities rose to 53.4 from 52.4, topping economists' expectations, as well as factory activities that strengthen in leading Asian exporters, China, South Korea and Taiwan. Also, output was still far from robust despite good results. From yesterday, also from UK, the economy staged a modest rebound in the first 3 months of 2012. That was helped by strong overseas demand, but country still faces a tough path back to healthy growth, as the British Chambers of Commerce said today. The trade group said its latest quarterly economic survey of nearly 8,000 businesses pointed to 0.3% first quarter growth, a shade above economists' consensus. But growth for the rest of the year was likely to disappoint, totaling just around 0.6% for 2012 as a whole. The first quarter was nonetheless a recovery, with the economy having contracted by 0.3% in the last 3 months of 2011, prompting fears the UK might slip into recession. Also important release was yesterday's FOMC minutes of the latest meeting, as the Federal Reserve policymakers signaled little appetite for further monetary steps to stimulate U.S. growth in an economy that is gradually strengthening. The comment from the Cleveland's Fed President Sandra Pianalto said that with the current outlook, she thinks that the policy stance is still the one the best suited for to foster steady gains in output and employment, and to maintain the stable prices. A voter on the Fed's policy setting panel this year, Pianalto is viewed as moderate, aligned with the core group of policymakers led by Chairman Ben Bernanke, who favor an activist approach to speeding up a sluggish recovery. The Dallas Fed President Fisher said the economic recovery is gaining momentum, and the central bank should not act hastily. A frequent critic of aggressive stimulus, he said in a television interview, the Fed should watch and wait for more conclusive evidence that the recovery will endure before deciding its next move. While Fisher saw no signs of dramatic inflationary pressures building, St. Louis Fed President Ballard pointed to tight overall global capacity, which he said could be putting some upward pressure on the U.S. economy. Inflation. Their comments overall suggest that there might be a high threshold for a further Fed easing, and that policymakers probably want to see a marked deterioration in the recovery before they would support firing another round of monetary stimulus. As we know, the Fed cut rates to near zero in December 2008, and has bought $2.3 trillion in bonds to boost growth. The recent news that hiring has been stronger than expected has led many analysts to project the Fed will have to raise interest rates earlier than the late 2004 date it has already indicated. But Fed Chairman Ben Bernanke said last week the relatively modest pace of U.S. growth is unlikely to lower the 8.3% unemployment rate quickly, and that further stimulative action would remain an option. The Fed is scheduled to release minutes today from its March meeting, which might offer further insight on how actively the central bank is considering additional steps to boost growth. The next policymakers meeting of Federal Reserves will be this month on 24th and 25th of April. We're going to take a look now in today's calendar and see the events that are already released or due to be released later today. Retail sales from Japan came as expected from Australia at 0.2%, as well as Japan average cash earning rose at 0.7% versus 0.2% forecast, and a negative figure of minus 0.9 of the previous month. The Australian Central Bank rate decision came as forecasted, unchanged at 4.25%. That significantly pushed the Aussie dollar overnight, that in the sharp slide dipped as low as 103.88. That was the session low posted earlier this morning, with the negative structure still seen on the current movements of Aussie dollar against the US dollar. Still to come at 8:30 GMT's UK's construction PMI for March. 53.5 is forecast for today, lower than the previous month release, as this is a part of what we already spoke about. The Eurozone's final GDP quarterly is due at 9 o'clock GMT, and a brief decrease by minus 0.30% is seen for today, along with the unchanged from the previous one. At the same time, Eurozone monthly PPI for February is expected to drop by 0.5% compared to 0.7% of the previous month, while yearly reading is also forecasted at 3.4, lower than the previous 3.7%. From U.S. monthly factory orders for February are expected to show some improvement. 1.5% growth is seen in orders for today's release, compared to 1% of the month of January. At the same time, 1400 GMT's total vehicle sales for March for US will decrease to 14.6 million units seen for today, forecasted for today, versus 15.1 million of the previous release. And the FOMC meeting minutes that we already mentioned are due at 1800 GMT. Quick look now at the markets to see the latest developments in the majors and the commodities, starting as always with euro. The pair remains within the range, as you can see it better on the 4-hour chart. That is limited at 133.80 zone. That so far in past couple of days, from last week, 27th of March, holds the upside, offers a very good resistance for now. On the downside, that remains so far protected, and the dips holding above our important support at 132.50, with yesterday's dip down that found support at 132.77, where the 55 days exponential moving average held the dip. Now fresh strength is underway as the pair, after a brief break below the main bull trend line, regained the strength, and currently trading at 133.50 and aiming higher for possible retest of our key barrier zone at 133.80, break of which is expected to resume the latest leg higher from 130.00 base and likely open way for test of next key barrier at 134.85, double top of end of February. The situation on the daily chart shows a positive tone dominating, especially that pair recently broke above the main bear trend line drawn of 142.46 peak and holds steady above this line, setting scope for a further extension higher, with the current ranging and sideways movement seen as a consolidation of the broader up move from 130.00, and the break above this level is set to open 134.34 is the next target, 50% retracement ahead of the static barrier at 134.85, and on the break we might see the extension towards 135.86, where is currently 200 days moving average standing. On the downside, 133.00 offers initial support ahead of overnight's dip to yesterday's low at 132.77, and also significant at 132.50, and holding above these levels keeps the focus at the upside. Keeps actually the current structure is more into the sideways. We need to see the regain of minimum 133.80 to improve the structure. However, the studies on the 4-hour charts are still holding in the positive territory. That gives the additional boost to the pair, while hourly studies started to improve as a fresh momentum is now developing, and the break above overnight's low at overnight's high, pardon, at 133.54 that is currently under attack would improve further the near-term structure and open way for test of our key barrier at 133.80 zone. On the downside, the only loss of 132.50, and what is just below this is 132.38, Fibonacci 38.2% retracement would be risky for the further easing of the pair, and my signal temporary top at 133.80 in favor of deeper reversal towards the next significant target, which is around the 132 zone, which is the low of 26th of March, as well as 50% retracement of 130 to 133.80 ascent. The cable holds the positive tone after hitting a fresh high at 160.61 yesterday, with the current sideways movement seen as consolidation, as the pair holds steady above 160.00, which is the previous high, and our initial support, where is also the 55 days hourly exponential moving average currently standing. Holding above this immediate support keeps the upside firmly in focus, with further consolidation seen here preceding a fresh rally, as studies remain on the hourly studies lost some of its initial bullish momentum. However, the overall outlook is still in the positive tone, holds the positive tone with further easing, corrective easing seen towards 160, 159.90, not being harmful for the current structure. I would say only break below 159.80, 159.65 lows would delay immediate bulls in favor of deeper reversal, while on the 4-hour chart studies are in the positive territory, but approaching some extended zone, and we might see also some further consolidation, corrective action before the fresh rally emerges from there. The situation on daily chart is firmly bullish after the pair broke above 200 days moving average and keeps the upside in focus, with break above 160.61 to open 160.90, 161.00, and then next levels 161.29, and a significant strong barrier at 161.64, where is also 61.8 Fibonacci retracement of the broader down move from 167.45 to 152.33. Dollar yen, as we mentioned in our yesterday's written report, says losing traction, as yesterday's fresh weakness dipped below our initial support at 81.95, 85, which is the break point, extending losses so far to 81.54. This has turned the near-term structure negative, as we can see that hourly studies in the negative territory, and current corrective bounce higher so far being limited by 20 days exponential moving average just above 82 level, and the top of the previous of yesterday's actually overnight's descent at 82.20 zone. We need to see break of this level to extend the current recovery. However, this is still seen corrective as long as initial support, resistance at 82.60 and 83.00 hold the upside, and this is likely going to limit the corrective action as 20 days exponential moving average on 4-hour chart that's currently pointing lower is currently at 82.38, and 55 days one is 82.60. So this is acting as quite a strong resistance at this point, with the daily studies in the negative, firmly negative, and pointing, all studies pointing lower, opening way for a possible stronger correction of the latest 76 to 84.17 ascent, as the pair is already in the corrective mode, reversal of 84.17, pardon, as the break below initial Fibonacci level at 23.6 now confirms the reversal. Next level on the downside is 81.05, 38.2 retracement, and a higher low at 80.55 zone. That are significant levels to be watched on the downside in case of further weakness and break below 81.54. On the upside, as mentioned, the 82.60, 83.00 offer initial resistance. However, break above 83.29 and 83.38 previous recovery tops is required to avert immediate downside risk and sideline the short-term bears, and open way for possible extension and towards tops at 84.08 at 84.17. For now, the focus on the near term remains on the downside, with current bounce in corrective ahead of fresh weakness. Immediate downside target at 81.54, and then 81.05 and 80.55. The dollar Swiss also remains under pressure, with the current past couple of days sideways movement seen as consolidation ahead of further weakness. The downside so far remains protected at 90.00, which marks yesterday's low, while the quick recovery attempt was capped at 90.69, just ahead of our initial barrier at 90.91, 91.00. These studies on the hourly chart are again losing traction and attempting below their midlines that might signal near-term price action aligned towards the downside. On the 4-hour chart, studies are in the negative territory, but currently in the sideways, rather neutral to negative movements, with the upside still being capped initially by 20 days exponential moving average at 90.34, and the broader action at 90.69, where the 55 days exponential moving average capped the yesterday's corrective bounce. The 4-hour chart studies are also aligned towards the downside as a part of the broader down move from 93.33 peak of 15th of March, and the loss of the latest support at 90.00 is expected to open way towards our next interim support is Fibonacci 61.8% retracement at 89.58, and the double bottom at 89.30, lows of 24th and 29th of February 2012, which is our main short-term target. The studies on the daily chart are also negative, especially after pair briefly broke below the main bull trend line drawn of 89.30. That further weakens the structure and keeps the downside in focus in the short term. A quick look at energies. The crude oil regained some ground after dipping yesterday to 102.06, just marginally lower than the previous low posted last week at 102.12, followed by narrow consolidation that was capped at 104.11. Fresh strength so far extended against to 105.45. With the hourly studies now being in the positive territory, but already overextended, I would say, with the RSI in the emerging out of the overbought territory and pointing lower. Basically, all the studies on the hourly chart are now started pointing lower and bring immediate support of 20 days moving average at 104.55, ahead of high of the last Friday at 104.11. That will be the next target, and the dynamic support at approximately the same zone, 104.1020, loss of which is to refocus lows at 102 zone. On the 4-hour chart, the studies are still negative, but regaining some ground and still pointing higher. We need to see break of minimum levels of 105.70, 105.50, 70, these peaks, in order to improve the situation. Currently the 55 days exponential moving average on the 4-hour chart is capping the upside action, and while holding here, it will keep more pressure to the pair and for possible extension towards 102. On the upside, break of these levels is to open way for further recovery, and next very significant levels are at 106 and the 107.70, 108 zone. That are the recent peaks. On the daily chart, studies are approaching, actually entering the negative territory, as the recent easing of 110.53 high posted on 1st of March and loss of the range, recent short-term range floor at 104.30 triggered the dip below the previous range ceiling at 103.70, breaking below 55 days moving average, with the support being found so far at 90 days moving average that currently stands at 101.94. Loss of this support at 102 zone is expected to further weaken the current price action and open way for further extension lower, with the next significant target is of $100 per barrel as psychological support. The yellow metal remains in the past couple of days in the steady recovery of recent low at 1645 posted last week, with the highest so far seen at 1683. The broader weakness of the dollar keeps the yellow metal now well supported. However, the studies on daily, on hourly are still positive, and the current consolidation above low at 1675 is seen preceding fresh strength, as the pair holds above the main short-term bull trend line drawn of 1645. On the 4-hour chart, the studies are improving now, the breaking above their midlines, and seeing potential of further recovery as the second part of the recovery attempt of 1628, with the higher low left at 1645. Main upside target is at 1697, 1700, the previous high, and the psychological barrier, clearance of which to open way for a further recovery of the broader fall of the yellow metal from 1790 peak of 29th of February that dipped so far to 1628. That was the low of 22nd of March 2012. A quick look on Fibonacci levels, just to have an idea what levels to watch. So 1690 is the 38.2% retracement, and 1697, 1700, which acts as a very strong barrier. At this point also we have the 200 days moving average. So our critical level is around 1690, 1700, and if the price breaks above this level, then it might signal a stronger recovery. 1709 is the 50% retracement, and the significant tops at 1716 and the 1725, 1st of March, and the 12th of March 2012 highs, and 1728 is 61.8%. We are focusing now at 1690, 1700 barrier. In case of break here, as the pair on daily is gaining momentum, would signal some stronger recovery. Otherwise, there is a risk of a lower top at this point and further weakness. Key near-term support at 1628, interim support at 1645, while on the larger picture, the key longer-term support is 1532, 1522, loss of which would open way for a more significant retracement of the longer-term ascent of gold that lasts from the beginning of the millennium, from around the year 2000, from 250 zone that peaked at 1920, the beginning of September 2011. Have a nice day, and thank you.